This video is about accounts receivable. Accounts receivable is really pretty simple. Customers owe you money and then they pay you. Where it gets difficult is when customers can't pay you. Whether they go bankrupt or flee the country, some customers default. Default means you don't receive your money. So how do we handle that as accountants? That'll be the first thing we talk about in this video. Next, we'll talk about disclosure. So what should you expect to find on most companies' financial statements in relation to their accounts receivable balance? And we'll use Intuit as an example. To show you how to account for customer defaults, we'll use a made-up numbers for a real company, Allbirds. Allbirds produces hipster shoes. They sell them for around $100 a piece. And what we're going to assume about Allbirds is that you can get the shoes today and pay later. And so Allbirds will have an accounts receivable that hopefully they can collect from you. And we'll start in 2019. So let's suppose the company begins operations in 2019. And in their first year, they sell 10 shoes on account. So that word on account, that means accounts receivable. They sell the shoes, but they haven't collected the cash yet. So they sell 10 shoes for $100 each. That's $1,000, 10 times 100. They'll have to credit revenue for $1,000 and debit accounts receivable for $1,000. Accounts receivable is an asset. It represents a benefit, a future benefit to the company that they should receive $1,000 of cash in the future. Next, during 2019, we're going to collect payment from 5 of those 10 customers. So 5 times $100 each, we're collecting $500 from those customers. So we can scratch out their accounts receivable with a credit, offsetting the debit balance. So a credit to accounts receivable of $500 and a debit to cash because we're receiving $500 of cash. Here's the accounts receivable T account for 2019. It had a beginning balance of 0 because we just started operations this year. Then we sold 10 pairs of shoes for $100 each, and accounts receivable went up by $1,000, or a debit of $1,000. 5 customers paid off, so a credit of $500. No customers defaulted during 2019, and we're going to get to that line item for the 2020 year, but so for 2019 it's 0. And the ending balance in the accounts receivable account is 500 because 0 plus 1,000 minus 500 minus 0 equals 500. Now we come to the end of 2019, and the exercise we need to do is estimate the allowance for doubtful accounts. The key word here is estimate. Management has the discretion to come up with the number they think is appropriate. What is the process they go through? Well, they look at those 5 customers. Let's look at them. $500. That's 5 customers. How many do we think aren't going to pay? That's the process they go through. And so let's say they decide we think 2 of them aren't going to pay. Okay, well, if 2 aren't going to pay, it's not really fair to say we have an asset of $500 because we don't expect to receive $500 in the future. We only expect to receive 5 minus 2, or 3 customers, which is $300. We expect to receive $300. So we need to reduce that asset value from 500 to 300. We don't just reduce the accounts receivable itself, we create an allowance account, which is this. The allowance account is a contra asset account. It's an asset account and it sticks on to the bottom of the accounts receivable account. It's a credit balance, so it takes that debit balance of 500 and it reduces it by 200 when you stick it on, so that the net of the 2 is $300. So that contra account is an asset account with a credit balance, and it offsets the accounts receivable balance to its net realizable value. Realizable means we expect to receive it, and that's what that allowance account does. The other side of the journal entry is bad debt expense. You can just think of this as a typical expense account. It shows up on the income statement during the period that you record it, and you close it out to retained earnings at the end of each period. That's bad debt expense. Now let me show you the T account for the allowance for doubtful accounts. Remember, this is a contra asset account. Typical asset accounts have a debit balance. This one has a credit balance. So its beginning balance is a credit. You establish the allowance using bad debt expense, and that's a credit to the allowance account. You use the allowance when customers default, which is what we'll see during 2020. So we haven't yet used our allowance. And then the ending balance, again, is going to be a credit balance. So for 2019, our beginning balance was 0 since we just started operations. We didn't have any customer defaults during the year. When we got to the end of the period, we decided we needed an ending balance of 200. That was to offset our ending balance in accounts receivable of 500. 500 minus 200 is 300, which is what we expect to receive. And with that ending balance of 200, we back into what bad debt expense should be. So the beginning balance of 0 plus the bad debt expense, which is a question mark at this point, minus customer defaults of 0 equals 200, which is the ending account balance that we want to have. And we come up with bad debt expense of 200. So just pay close attention to the order of operations here. We start with our beginning balance. Then we have customer defaults that occurred during the year. We get to the end of the year and we decide what we want for an ending balance, and we back into what bad debt expense should be for that year. Here's what the balance sheet will look like, and let's just pay attention to the 2019 column for Allbirds. This is what it will say is accounts receivable, but it's not gross accounts receivable, it's accounts receivable net. What is it net of? It's net of the allowance for doubtful accounts of $200. So what we show on the balance sheet is a $300 balance. That's the amount we expect to receive, $300. $200 is the amount we don't expect to receive. How much do customers owe us? Well, customers owe us $500 in total, but we only expect to receive $300. So that's what we consider the net asset value. Here's the income statement, and all I'm showing you here is something called revenues net. And the way I've calculated revenues net is I've taken our total revenue of $1,000 and I've subtracted off our bad debt expense, which is just a typical expense account, to get to net revenue of $800. I could have easily just put bad debt expense somewhere else on the income statement, but I've chosen to just present revenues net of the bad debt expense. The reason this should make sense to you is it's not fair to show $1,000 of revenue, because we sold to some, anybody can sell to customers who are never going to pay, right? You can show any revenue number you want doing that. We need to show the revenues of customers we expect to collect from. That's why $800 is a fair revenue number for 2019. Okay, now let's move into 2020. 3 activities are going to occur during 2020. We're going to sell more shoes. So 20 more shoes, $100 each. That's $2,000 of new revenue, credit revenue, debit accounts receivable. We're going to collect payment from 15 customers. That's 15 times $100 each, $1,500. We're going to receive $1,500 of cash, and we're going to scratch those 15 customers off of our accounts receivable balance. So a credit to accounts receivable to remove them from the balance. Finally, a new event is going to occur during 2020. We're actually going to receive default notices from 3 customers. I don't really know how this happens. Either they call you and say, look, we're not going to pay, or you just can't get a hold of them anymore, so you want to stop making phone calls. But the short answer is we're going to take them off of the list of people who we're going to follow up on. So we're taking them out of the accounts receivable balance. Here's how we do it. We credit the accounts receivable balance. That reduces the accounts receivable balance. The debit is to the allowance account, the allowance for doubtful accounts. This is how we use the allowance. Use the allowance. This is how we use the allowance for doubtful accounts. So here's the accounts receivable T account for 2020. It had a beginning balance of $500. We sold 20 more pairs of shoes, so that's $2,000 more that we're owed. 15 customers paid us, so the accounts receivable balance went down by $1,500. Then we wrote off 3 customer accounts for a total of $300. So $500 plus $2,000 minus $1,500 minus 300 equals a $700 ending balance. That $700 represents 7 customers who still owe us money at the end of 2020. Now we come to the end of 2020 estimation procedure. At the end of the year, we look at those 7 customers and we decide how many do we think aren't going to pay. This time we think 4 customers aren't going to pay. So what journal entry do we record based on this estimate? It's not as simple as in 2019. Let's look at the allowance for doubtful accounts T account. We had a beginning balance of $200. Then we had customer defaults of $300. Now we want an ending balance of $400. So here's our equation. You start with a $200 beginning balance plus bad debt expense minus $300 default, and we want a $400 ending balance. And so bad debt expense has to be $500 to make this T account work. Remember, this is the order of operations. Beginning balance first, customer default second, ending balance third, and solve for bad debt expense of $500. Now we're ready to record this bad debt expense journal entry with a credit to the allowance, re-establishing the allowance to $400, and a debit to bad debt expense. So the 2020 income statement is going to have $500 of bad debt expense on it. Here's what the 2020 balance sheet looks like. Accounts receivable net is $300. That's how much we expect to collect. How much do we not expect to collect? $400. So the $400 relates here, and the $200 relates to 2019. That's how you read those paragraphs in the label. And the income statement is also pretty straightforward. Here we're showing net revenues of $1,500. That's the total revenue, and that's 2020. So the net revenue is $1,500. It's total revenue. We sold 20 pairs of shoes. We had bad debt expense of $500. So the net revenues is $1,500. Okay, finally I want to go through the disclosure of the accounts receivable balance. When you go to any company's balance sheet, what can you expect to see disclosed? We'll use Intuit as an example. The key business line for Intuit that has an allowance account is probably QuickBooks. I think you're required to pay for TurboTax before you use it, same with Mint. But QuickBooks, many companies use QuickBooks to keep track of their accounting records, and some of those companies go bankrupt. So sometimes Intuit will let companies use their QuickBooks software, but they'll never get paid for the use of it. Here's what Intuit's balance sheet looks like. They have an accounts receivable balance net of the allowance for doubtful accounts of 3 and 5. So remember, the 3 relates to the first column, and the 5 relates to the second column. And this balance sheet is in millions. So how can we interpret this balance sheet? And here it is. And let's just worry about this 2019 column. So as of July 31st, 2019, how much do customers owe Intuit? Well, Intuit expects to collect 87, and they expect to not collect 3. So the amount total that they're owed is $90 million. And if you subtract the amount they don't expect to collect of 3, you get 87, which is the net value of the accounts receivable asset. Since the allowance is a somewhat significant account for Intuit, they'll also, so the customers owe 90, expect to default on 3, and they expect to receive 87. Okay, finally, because the allowance account is a somewhat significant account for Intuit, they'll present this schedule for you. This is called Schedule 2. Schedule 2 is just basically the T account for this allowance account. So you can see the allowance for doubtful accounts for the year ended July 31st, 2019, had a beginning balance of 5, had additions charged to expense of 59, had deductions of 61, and an ending balance of 3. These numbers represent entries to the T account. So the beginning balance of 5, that's a credit beginning balance. The additions charged to expense, that's bad debt expense of $59 million. The deductions, that's when you're using the allowance, those are actual customer defaults of $61 million. And the ending balance is a credit of $3 million. So in this video, we learned that accounts receivable is a gross balance. Accounts receivable is the total amount owed to a company at the period end. It's not the amount the company expects to collect. We reduce accounts receivable using a contra asset account. The contra asset account sticks to the bottom of the accounts receivable account and reduces it to its net realizable value. And that contra account's called the allowance for doubtful accounts. That account is an estimate of how much of the accounts receivable balance will default in the future. On a company's balance sheet, what you'll find is the net accounts receivable balance. So the amount that is an asset is the amount that the company expects to receive in the future. On a company's income statement, what you'll find is the net revenues. Not the total amount they sold, but the amount that they sold and they expect to receive from customers.